When a company goes public, it decides to sell shares of its ownership to the public in return for capital. This process is known as an initial public offering, IPO. By selling part of the company raises funds from external investors who become shareholders and have ownership rights in the company. The company can then use the capital raised from the IPO to finance its operations, investments, and growth strategies. Going public allows the company to access a larger pool of capital and provides liquidity for existing shareholders. What is the role of treasurers and finance officers? Treasurers and finance officers play a crucial role in managing the financial aspects of an organization. They are responsible for overseeing the budgeting process and ensuring that the organization's financial goals are met. Some specific responsibilities of treasurers and finance officers include 1. Budgeting and financial planning. Treasurers and finance officers are involved in the development and implementation of the organization's budget. They analyze financial data and market trends to create accurate financial forecasts and projections. They also develop financial plans to help the organization achieve its long-term financial goals. 2. Cash management. Treasurers and finance officers are responsible for managing the organization's cash flow. They monitor and control the inflow and outflow of cash to ensure that the organization has enough liquidity to meet its financial obligations. They also develop strategies to optimize the use of cash resources and minimize financial risks. 3. Investment management. Treasurers and finance officers are involved in managing the organization's investment portfolio. They analyze investment opportunities, assess risks, and make recommendations on where to invest the organization's funds. They monitor the performance of investments and make adjustments as necessary to ensure optimal returns. 4. Financial reporting and analysis. Treasurers and finance officers prepare and analyze financial reports to provide accurate and timely information to senior management, shareholders, and other stakeholders. They ensure compliance with financial regulations and standards, and they provide insights and recommendations based on their analysis of financial data. 5. Risk management. Treasurers and finance officers are responsible for identifying, assessing, and managing financial risks faced by the organization. They develop risk management strategies and policies to minimize the impact of financial risks on the organization's operations and financial performance. They may also be involved in obtaining insurance coverage to protect the organization against potential losses. Overall, treasurers and finance officers play a critical role in managing the financial resources of an organization and ensuring its long-term financial stability and success. What is the main focus of investment decisions? The main focus of investment decisions is to determine how to allocate capital in order to maximize the value of the company over a desired time period. Investment decisions involve selecting which assets to acquire or invest in based on their expected return and risk. The goal is to make investments that will generate the highest possible return for the company. Capital investment decisions include determining how to allocate funds for long-term projects and investments. This involves evaluating the value and potential return of different investment opportunities and deciding on the best way to finance them. These decisions are based on factors such as the size, timing, and predictability of cash flows, as well as the company's risk tolerance. The goal is to maximize shareholder value by making sound investment choices and financing them appropriately. Roles of financial management and skills for financial managers.
Roles of financial management and skills for financial managers. Financial management plays a crucial role in the success and growth of businesses. The primary goal of financial management is to maximize shareholder value by making optimal investment and financing decisions. These decisions are essential for allocating resources effectively and ensuring the financial health of the organization. The roles of financial management include 1. Investment decisions. Financial managers are responsible for determining how to allocate capital to different projects and investments. They evaluate potential investments, assess their risks and returns, and make decisions that will maximize the value of the firm. This involves analyzing cash flows, estimating future revenues and costs, and considering the time value of money. 2. Financing decisions. Financial managers also need to decide how to finance the company's investments and expenses. They must consider whether to use internal funds, borrow money, or sell equity. This decision involves assessing the cost and availability of different sources of financing and balancing the company's short-term and long-term financial needs. 3. Dividend decisions. Financial managers play a role in determining whether the company should pay dividends to its shareholders and how much to distribute. This decision is based on maximizing shareholder value and involves balancing the company's need for reinvestment with the desire to provide returns to shareholders. In addition to these specific roles, financial managers also perform data analysis, advise senior managers on profit-maximizing ideas, and ensure that the company's financial statements comply with legal requirements. To effectively fulfill these roles, financial managers require a set of skills including 1. Analytical skills. Financial managers need strong analytical abilities to analyze financial data, evaluate investment opportunities, and make informed decisions. They must be able to assess the financial implications of different choices and identify the best course of action. 2. Communication skills. Excellent communication skills are essential for financial managers as they need to explain complex financial concepts and reports to non-financial stakeholders. They must effectively communicate financial information to senior management, investors, and other relevant parties. 3. Attention to detail. Financial managers must pay close attention to detail when preparing and analyzing financial statements, budgets, and reports. Accuracy is crucial to ensure the financial health of the organization and compliance with accounting standards. 4. Math skills. Financial managers need a solid foundation in mathematics, including algebra and financial calculations. They must be able to understand and apply financial formulas, analyze financial data, and make accurate calculations. 5. Organizational skills. Financial managers deal with a large amount of information and documents. They must be well organized to effectively manage financial records, budgets, and reports. 6. Ethical awareness. Financial managers must adhere to ethical principles and conduct themselves in accordance with professional standards. They have a responsibility to act in the best interest of the company and its stakeholders, making ethical decisions and maintaining integrity in their financial practices. Overall, financial management is a critical function in businesses, and financial managers play a vital role in making sound financial decisions, managing assets, and ensuring the financial health of the organization. What is the function of the finance group in a company? The finance group in a company is responsible for various functions related to managing the company's financial resources. Their main function is to ensure the optimal allocation of assets across all business functions. This involves budgeting, determining how much money should be allocated to each part of a business, and valuing projects and investments to determine their worth. The finance group also plays a role in determining how projects should be financed, whether through internal funds, borrowing, or selling equity. They must balance both short-term and long-term goals with the overarching goal of maximizing shareholder value. Additionally, the finance group is involved in financial reporting, analysis, and decision-making, providing insights and recommendations to senior managers on profit-maximizing ideas. Why is time important in finance?
Why is time important in finance? Time is important in finance for two main reasons. Firstly, the concept of the time value of money recognizes that money has more value in the present than the same amount of money in the future. This is because money can be invested and earn returns over time. Therefore, finance seeks to maximize the value of assets by considering the time value of money and making decisions that generate higher returns in the future. Secondly, finance acknowledges that the value of assets changes over time. By understanding how assets change in value, finance aims to manage and allocate assets in a way that ensures they are worth more in the future. This involves making informed investment decisions and managing risks associated with the changing value of assets. In summary, time is important in finance because it affects the value of money and assets. By considering the time value of money and understanding how assets change in value over time, finance aims to optimize asset allocation and generate favorable outcomes for individuals and organizations. Explain the concept of corporate finance in business scenarios. Corporate finance is a branch of finance that deals with the monetary decisions made by business enterprises. It involves the analysis, planning, and management of financial resources to maximize the value of a company. In various business scenarios, corporate finance plays a crucial role in decision-making and ensuring the financial health of the organization. One of the key functions of corporate finance is budgeting. The finance department is responsible for allocating financial resources across all business functions to achieve optimal asset allocation. This involves determining how much money should be allocated to each part of the business and ensuring that the funds are utilized in the most effective way. Corporate finance also involves making investment decisions. This includes evaluating different investment opportunities and determining which projects will yield the highest returns for the company. The finance department uses various methods, such as valuation techniques and financial analysis, to assess the potential value of each project. The goal is to maximize shareholder value by investing in projects that generate positive net present value. In addition to investment decisions, corporate finance also deals with financing decisions. This involves determining how to finance projects and cover expenses. Companies can use internal funds, borrow money, or sell equity to finance their operations. The finance department must assess the costs and benefits of each financing option and choose the most optimal mix of financing strategies. Furthermore, corporate finance is responsible for managing the company's liabilities. This involves ensuring that all projects are financed in an optimal way without taking on excessive risk. Financial managers analyze market trends, evaluate credit risks, and develop strategies to manage financial risk and uncertainty. Overall, corporate finance is essential for the success and growth of a business. It helps businesses make sound financial decisions, allocate resources effectively, and maximize shareholder value. By understanding the principles and concepts of corporate finance, businesses can navigate various business scenarios and achieve their financial goals.
The study of finance and its importance in asset allocation. Finance is the study of fund management and asset allocation over time. The three main areas of finance are financial institutions, financial markets, and financial management. The two main drivers of finance are the time value of money and risk. Finance seeks to ensure that the change in the value of assets over time is beneficial for individuals and organizations. Financial professionals operate in an environment of uncertainty and make forecasts about future events. Key terms in finance include investment, asset, and debtor. Funds consist of money and other assets, and finance aims to allocate these assets efficiently in various conditions over time. Time is a crucial factor in finance because of the time value of money and the risk involved in investments. Finance embraces the fluctuation of asset value over time and aims to manage assets to increase their future worth. Figuring out asset allocation is challenging due to uncertain variables, leaving companies to hire finance professionals to make informed decisions. Finance, economics, and accounting are related business subjects, with both similarities and differences. Distinctions between finance, economics, and accounting. Finance is the study of allocating assets and focuses on future asset value. Economics analyzes the production, distribution, and consumption of goods and services, and studies cause and effect. Accounting communicates a company's financial information and focuses on past events and their impact on the present. Finance, economics, and accounting overlap in various areas, with investors using all three to make predictions about a company's future. All three fields are interconnected, and it's essential to have a basic understanding of each to have a strong grasp of any one field. Finance is relevant to all business functions, the macroeconomy, and personal finances. The importance of finance in today's world. Like companies, individuals are faced with investment and financing decisions. Understanding finance is crucial for individuals to make informed decisions. All business functions deal with finance as they need to justify funding for projects and manage budgets. Key term. Leverage refers to the use of borrowed funds to increase business investment and potential returns. Finance is relevant to many news stories, providing a better understanding of the world's events. Personal finances require individuals to make investment and financing decisions similar to corporations. Individuals can use savings or take out loans, understanding the importance of comparing options and leveraging. Finance is essential for careers in finance and accounting, but it is also integrated into various business functions. Nearly every job requires budget management and making a case for financial support. Finance involves analytical skills and personal judgment due to uncertainty in real-world scenarios. Although finance may seem narrow, it has a broad impact on everyday life. Finance explains the health of the overall economy and the reasons behind recessions and stock market fluctuations. Corporate finance, maximizing shareholder value and asset management. Corporate finance involves making financial decisions in business enterprises. The primary goal is to maximize shareholder value, which can be done in the long term or short term. The finance department needs to find a balance between these goals, even if they appear contradictory. Asset management is crucial for maximizing shareholder value and involves allocating assets effectively. The finance department also manages liabilities to ensure optimal financing without taking on excessive risk. Other branches of finance include personal finance and public finance. Dividends can increase short-term shareholder wealth, but may limit long-term investments. The finance department assesses proposals and projects, considering future revenues and costs to determine the best use of resources. They also analyze when to take on liabilities, such as borrowing money for profitable projects.
The role of financial managers in an organization. The finance department's role is to ensure money is in the right place at the right time. Financial managers analyze data and advise senior managers on profit-maximizing ideas. Technological advances have reduced the time it takes to produce financial reports, changing the role of financial managers. Types of financial managers include controllers, treasurers, credit managers, cash managers, risk managers, and insurance managers. Financial managers prepare financial statements, monitor legal requirements, supervise financial reporting and budgeting, review company financial reports, analyze market trends, and help make financial and investment decisions. Financial managers may perform more data analysis and advise senior managers on maximizing profits. Financial managers also have industry-specific tasks and must be aware of tax laws and regulations. Capital investment decisions are long-term decisions based on various criteria to maximize firm value. Overview of capital investment decisions and types of financial managers. Capital investment decisions are comprised of an investment decision, a financing decision, and a dividend decision. These decisions involve allocating limited resources between competing projects through capital budgeting. Financing for corporate investments can come from self-generated capital or external funders through issuing new debt or equity. Different types of financial managers exist, such as controllers who prepare financial reports and oversee accounting and audit departments. Treasurers and finance officers manage budgets, investment of funds, and develop financial plans for mergers and acquisitions. Credit managers set credit criteria, monitor collections, and oversee credit business. Cash managers control cash flow to meet business and investment needs. Risk managers manage financial risks through hedging and other strategies. Insurance managers protect against losses by obtaining insurance for risks like disability payments or lawsuits. Important skills for financial managers include analytical skills, communication skills, attention to detail, math skills, and understanding of international finance. Functions of corporate finance in business and financial management. Corporate finance helps companies make financial decisions and manage their assets and operations. The finance group is responsible for budgeting and allocating assets across all business functions. Corporate finance decides how to finance projects, whether through internal funds, borrowing, or selling equity. The finance group must balance short and long-term goals to maximize shareholder value. Finance is different from accounting as it focuses on funding transactions and backings. Investment is the placement of capital for income or profit, while corporate finance focuses on investment and financing decisions. The finance group allocates limited resources and determines the best utilization for each part of the business. Valuing projects accurately is crucial for optimal allocation of resources. The finance department must determine how to finance projects, considering the costs and quantifying the options. Paying dividends is one function of corporate finance, with the goal of maximizing shareholder value. The role of dividends and financial principles in business decisions. A dividend means that money is not being reinvested in the company, potentially increasing shareholder value. The finance department determines the option that maximizes shareholder value. The finance department also ensures a balance between long and short-term goals, covering both working capital management and long-term growth. Ethics are the set of moral principles that guide a person's behavior. Ethical behavior is based on written and unwritten codes of principles and values held in society. Ethics reflect beliefs about what is right and wrong, just and unjust, good and bad in terms of human behavior. Ethical principles and values guide behavior on personal, professional, and organizational levels. Ethics are shaped by social norms, cultural practices, and religious beliefs. Ethical beliefs can influence the choices made by decision-makers for their organizations. Business ethics and corporate ethics apply ethical values to business activities. Professional ethics apply to specialized knowledge and skills exercised by professionals, such as managers, lawyers, and accountants. Professionals have obligations to those they serve, such as confidentiality for lawyers and honesty for accountants.
Importance of personal values in ethical decision-making. Professional organizations and licensing authorities set and enforce ethical standards. Corporate social responsibility emphasizes ethical behavior and the elimination of unethical practices. When personal values align with company norms, employees are more likely to make ethical decisions. Personal values provide an internal reference for determining what is good, beneficial, important, useful, beautiful, and constructive. Personal values are shaped by family, teachers, classmates, and religion. In adulthood, personal values influence how individuals carry out their responsibilities to others. Organizations can have a powerful influence on employees' values and ethical behavior. Conflicts can arise when personal values clash with organizational norms. Understanding one's personal values is crucial for making ethical and moral choices. Importance of personal values in ethical decision-making for business success. Personal values play a crucial role in justifying ethical or moral decisions to others. If personal values are not aligned with the organization's policies, it can lead to negative attitudes and behaviors in the workplace. Investment and financing decisions aim to maximize shareholder value. Investment decisions focus on allocating capital to assets with the highest return. Short-term and long-term goals must be balanced in making investment decisions. The finance team determines expected returns for investments. The right mix between long-term and short-term investment is essential. Financing decisions involve obtaining funds for business operations. Financing options include using existing capital, borrowing, or selling equity. The overall goal of financial decisions is to maximize shareholder value. The importance of financing in investment decisions. The average return on an investment is not guaranteed, but it is the average return if the investment were to be made multiple times. Investments must meet three main criteria: maximizing the value of the firm while considering risk aversion, appropriate financing, and returning cash to shareholders if no suitable investment opportunities are available. In order to pay for all functions of a company, the finance department must determine the financing process. Two ways to finance an investment are using the company's own money or raising money from external funders. Raising money from external funders can be done through debt, repaid with interest, or selling equity. Selling part of a company going public is an example of selling equity, where a company sells stocks to the public to raise money. The financing decision process determines how an investment will be financed, whether through company money or external funders. Overview of finance and its key concepts. Finance is the study of fund management and asset allocation over time. The three main areas of finance are financial institutions, financial markets, and financial management. The two main drivers of finance are the time value of money and risk. Finance seeks to ensure that the change in asset value over time is beneficial for organizations or individuals. Financial professionals operate in an environment of uncertainty and make forecasts about future events. Key terms include investment, asset, and debtor. Finance focuses on how to allocate assets in different conditions over time. Time is crucial in finance due to the time value of money and the consideration of risk. Managing assets to increase their value over time is a goal in finance. Finance faces challenges due to uncertainty and the need to determine the best options for asset management. Finance, economics, and accounting share similarities and differences. Distinct fields of study: finance, economics, and accounting. Finance is the study of how to optimally allocate assets, focusing on future asset worth. Economics is a social science analyzing production, distribution, and consumption, studying cause and effect. Accounting communicates a business's financial information, focusing on past events and their present impact. Finance, economics, and accounting overlap in different areas, influencing one another. It is difficult to fully grasp one field without at least a basic understanding of the other two. Finance is relevant to all business functions, the macroeconomy, and personal finances. The importance of finance in personal and business decision-making. Individuals and companies both face investment and financing decisions, making a firm grasp of finance crucial. Finance is involved in all business functions as it is necessary to argue for funding and manage budgets. Key term: leverage, the use of borrowed funds to increase the ability to invest and earn a higher return. Understanding finance helps individuals comprehend how they are affected by world events. Personal finance requires individuals to make projections and valuations, compare options, and leverage resources. Finance is essential in jobs ranging from investment banker to CFO to venture capitalist. Nearly every job involves managing budgets and making a business case for funding. Finance requires analytical skills and personal judgment due to the uncertainty of real-world scenarios. Finance impacts daily life and the overall economy, explaining economic downturns and stock market performance. Finance is relevant regardless of career aspirations in the field. Corporate finance. Corporate finance is the area of finance that deals with the monetary decisions made by business enterprises. The primary goal of corporate finance is to maximize shareholder value. This can be done over the long term or the short term, so the finance department's job is to determine how best to achieve both. Sometimes the goals of maximizing short-term and long-term shareholder value may appear to be in competition with each other. The finance department is responsible for allocating assets to maximize shareholder value. They must ensure that the right assets are in the right place at the right time. The finance department also manages the company's liabilities to ensure optimal financing without taking on too much risk. Shareholders are those who own shares of stock. Assets are anything of value, while liabilities are obligations or debts owed to someone. Maximized shareholder value is achieved through the management of assets and determining when to take on liabilities. The role of financial managers in an organization. The finance department ensures that money is in the right place at the right time and maximizes shareholder value. Financial managers perform data analysis and advise senior managers on profit-maximizing ideas. Technological advances have reduced the time it takes to produce financial reports, changing the role of financial managers. Financial managers prepare financial statements, monitor legal requirements, supervise financial reporting and budgeting, and seek opportunities for expansion or acquisition. They may also assist in making financial and investment decisions, acting as business advisors to top executives. Financial managers must be knowledgeable about industry-specific tasks, such as government appropriations and budgeting for government financial managers and healthcare finance for healthcare financial managers. Capital investment decisions, based on various criteria, aim to maximize the value of the firm. Overview of financial management and skills for financial managers. Capital investment decisions involve investment, financing, and dividend decisions. Management must allocate resources between competing projects in the capital budgeting process. Corporate investments must be financed appropriately through self-generated capital or capital from external funders. Controllers prepare financial reports and oversee accounting, audit, and budget departments. Treasurers and finance officers handle budgeting, investments, and financial plans for mergers and acquisitions. Credit managers set credit criteria and monitor collections of past accounts. Cash managers monitor and control cash flow for business and investments. Risk managers use hedging and other strategies to control financial risk. Insurance managers obtain insurance coverage to limit company losses. Financial managers need analytical, communication, attention to detail, and math skills. Overview of corporate finance in business scenarios. Corporate finance involves making financial decisions and managing assets and operations in various business scenarios. The finance group is responsible for budgeting and allocating funds across all business functions. The department determines the best way to finance projects, using internal funds, borrowing, or selling equity. The finance group must balance short and long-term company goals with the overarching goal of maximizing shareholder value. Finance differs from accounting as it focuses on funding transactions and supporting business undertakings. Corporate finance involves valuing projects and determining how to allocate resources effectively. Financing options include internal funds, borrowing, or selling equity, each with its own cost considerations. The finance department also decides on dividend payments to maximize shareholder value. Principles of ethics and financial decision-making in business. A dividend indicates that money is not being reinvested in a company, while reinvesting it can increase shareholder value. The finance department determines which option maximizes shareholder value and maintains a balance between long and short-term goals. Ethics are the moral principles guiding behavior influenced by social norms, cultural practices, and religious beliefs. Ethics reflect beliefs about what is right or wrong, just or unjust, good or bad in terms of human behavior. Ethical principles and values serve as a guide to behavior on personal, professional, and organizational levels. Ethics apply to conduct for individuals, groups, and organizations in all aspects of business activities. Professionals such as managers, lawyers, and accountants have professional ethics and obligations to their clients. Professional obligations include confidentiality, integrity, and providing specialized knowledge and skills to serve customers or the public. Ethical behavior and personal values. Professional organizations and licensing authorities enforce ethical standards. Corporate social responsibility requires organizations to understand and eliminate unethical behaviors. Personal values influence ethical decision-making in the workplace. Personal values serve as an internal reference for what is good and important. Personal values are developed through family, education, and religion. Personal values are especially significant in adulthood when carrying out responsibilities to others. Organizations have a powerful influence on employees' values and behavior. Conflicts can arise when personal values clash with organizational norms. Understanding personal values is crucial for making ethical and moral choices. Importance of personal values in decision-making, an overview of investment and financing decisions in business. Without awareness of personal values, it becomes challenging to justify decisions from an ethical or moral standpoint. Personal values inform attitudes and behaviors towards work and can influence employee productivity and retention. Investment decisions involve allocating capital to maximize value, while financing decisions focus on how to pay for investments and expenses. The primary goal of both investment and financing decisions is to maximize shareholder value. Companies can use existing capital, borrow, or sell equity to finance their operations. Investment decisions require balancing short-term cash needs with long-term growth prospects. Expected return is an important factor in investment decision-making, as there are no guarantees in most investments. Exploring the art of financial decision-making in an uncertain landscape. Finance is the study of managing assets over time, driven by the time value of money and risk. It involves making decisions about investments, debtors, and financial markets in an uncertain environment. The intersection of finance, economics, and accounting. Understanding the synergy of business analysis. Finance, economics, and accounting are interconnected fields that focus on different aspects of business and economic analysis. Finance is about optimally allocating assets. Economics analyzes production and consumption, and accounting communicates financial information. While they overlap, each field has its distinct characteristics and applications. The importance of finance in business, personal finances, and the economy. Finance plays a crucial role in business, personal finances, and the economy as a whole. It involves analyzing and managing investments, financing decisions, and financial risk. Whether you work in finance or not, understanding finance can help you make informed decisions about your own finances and better understand the impact of economic events. Maximizing shareholder value, decisions, and strategies in corporate finance. Corporate finance is the area of finance dealing with monetary decisions made by business enterprises. Its primary goal is to maximize shareholder value by allocating assets and managing liabilities. The finance department must determine how to allocate funds to maximize long-term and short-term shareholder value, while also managing risks and liabilities. Key terms include shareholder, asset, liability, and corporate finance. Maximizing profits. The role and responsibilities of financial managers. Financial managers ensure the financial health of an organization through investment activities and long-term financing strategies. They produce financial reports, direct investment activities, and develop strategies and plans for the long-term financing of their organization. Financial managers may perform more data analysis and advise senior managers about how to maximize profits.
Navigating investment decisions, the essential skills for financial managers. Investment decisions involve estimating the value of projects and financing them appropriately. Capital investment decisions comprise investment, financing, and dividend decisions. Financial managers focus on different areas of management, such as controlling, treasury, credit, cash, and risk management. Analytical, communication, and attention to detail skills are essential for financial managers. Maximizing shareholder value. The role of corporate finance in sound financial decision-making. Finance is crucial in business, and corporate finance utilizes tools and analysis to help companies make sound financial decisions while managing their assets and operations. The finance group is responsible for budgeting and allocating resources across business functions, while also deciding how to finance projects, balance short- and long-term goals, and maximize shareholder value. The intersection of business ethics and financial strategy. The text discusses the importance of business ethics and how it is shaped by individual and organizational values. It also highlights the role of finance departments in determining which investment options maximize shareholder value, while ensuring a balance between short- and long-term goals. Navigating ethical dilemmas. The clash between personal values and organizational norms. Personal values provide a framework for making ethical choices in adulthood, influenced by family, religion, education, and workplace culture. Conflicts may arise between individual moral values and organizational norms, leading to ethical dilemmas. The impact of personal values on ethical decision-making and productivity. Personal values play a crucial role in justifying ethical or moral decisions in the workplace. Without awareness of one's values, it can be difficult to persuade others of one's position. In a company with unequal treatment of managers and workers, an employee who values equal rights may have a negative attitude and performance. A more egalitarian policy would likely improve attitude and productivity. Investment and financing decisions involve spending and borrowing money to maximize shareholder value. Investment decisions concern what assets to buy, while financing decisions concern how to pay for them. Companies must balance short-term and long-term goals to make informed decisions. The expected return on investment is the average yield an investor predicts considering external factors. Financing refers to providing funds for a business, while equity is ownership of a business. Investment and financing decisions are fundamental to business success and must be made with the goal of maximizing shareholder value. The 3 criteria for maximizing investment returns and the financing decision process. The average return on an investment is maximized if it meets 3 criteria: maximizing firm value, appropriate financing, and returning cash to shareholders. If no investment opportunity meets the first 2 criteria, financing can be done through company money or raising funds from external sources, which can be done by taking on debt or selling equity. Going public involves selling shares of the company to the public in return for money. The financing decision process determines the optimal way to finance an investment. The time value of money and risk. The foundation of finance. Finance is the study of managing and allocating funds over time, driven by the time value of money and risk. It involves analyzing and making decisions about investments, debtors, and assets, often in an uncertain environment. The importance of time in finance is highlighted by the time value of money and risk. Finance professionals work to ensure that assets are worth more in the future than they are today. The interconnected world of finance, economics, and accounting. Finance, economics, and accounting are interconnected business subjects that focus on different aspects of a company's financial health. Finance is about optimizing asset allocation. Economics studies production and consumption, and accounting communicates financial information. Accounting is backward-looking, while economics and finance are forward-looking. They all influence each other, but each has its distinct field of study. Finance involves investing assets to maximize returns. Economics analyzes cause and effect relationships in the economy, and accounting prepares financial statements to communicate a company's financial health. understanding one field without the others is almost impossible. The impact of finance on personal and business decision-making. Finance plays a crucial role in personal and business decision-making, involving investment and financing choices. It affects individuals' personal finances and businesses' financial strategies, from investment banking to venture capitalism. The 2008 recession demonstrated the impact of finance on the economy, making it an essential field of study for anyone interested in business or finance. Strategic asset allocation and liability management for maximizing shareholder value. Corporate finance aims to maximize shareholder value by managing assets and liabilities. The finance department determines how best to allocate assets for long-term and short-term goals, while ensuring that the right assets are in the right place at the right time. Maximizing shareholder value involves managing risks and opportunities, as well as determining when to take on liabilities. Ultimately, the goal is to ensure that the company's financial decisions align with its overall objectives. Maximizing profitability. The role of financial managers in strategic decision-making. Financial managers ensure the financial health of an organization through investment activities and long-term financing strategies. They prepare financial statements, monitor legal compliance, analyze market trends, and advise senior managers on profit-maximizing ideas. Responsibilities may include data analysis, financial reporting, budgeting, and teamwork with other business advisors. Capital investment decisions involve fixed assets and capital structure and are based on several criteria, including maximizing shareholder value. Making sense of corporate finance, maximizing shareholder value, and strategic decision-making. Finance is crucial in business, and corporate finance specifically deals with financial decision-making for companies. This includes budgeting, project financing, and balance between short and long-term goals to maximize shareholder value. The finance group must also determine how to allocate resources and value projects accurately. Finally, corporate finance decides on dividends and other shareholder-related decisions. Maximizing shareholder value through strategic financial management. Maximizing shareholder value through strategic financial management. The finance department must balance short-term and long-term goals while ensuring enough capital for growth. They also determine which option maximizes shareholder value, whether it be paying a dividend or reinvesting in the company. Internalizing cultural values. The significance of personal values. Personal values provide an internal reference for what is good, beneficial, important, useful, beautiful, desirable, and constructive, and they exist in relation to cultural value in agreement with or divergent from prevailing norms. Maximizing shareholder value through investment and financing decisions. Investment and financing decisions in business aim to maximize shareholder value by allocating capital and borrowing funds respectively. Investment decisions involve choosing assets that yield highest returns, while financing decisions involve paying for investments and expenses through existing capital, borrowing, or selling equity.
What is the study of fund management and asset allocation over time? Finance is the study of fund management and asset allocation over time. Investment, a placement of capital in expectation of deriving income or profit from its use. Asset, something or someone of any value, any portion of one's property or effects so considered. Debtor, a person or firm that owes money, one in debt, or one who owes a debt. What are the three main areas of finance? The three main areas of finance are financial institutions, financial markets, and financial management. What are the two main drivers of finance? The two main drivers of finance are the time value of money and risk. What does finance seek to ensure in regards to the change in the value of assets over time? Finance seeks to ensure that the change in the value of assets is beneficial for the organization or individual. What do financial professionals have to do in an environment of uncertainty? In an environment of uncertainty, financial professionals have to make forecasts about future events. Shareholder, one who owns shares of stock. Liability, an obligation, debt, or responsibility owed to someone. What is finance? Finance is the study of fund management and asset allocation over time. What are the three main areas of finance? The three main areas of finance are financial institutions, financial markets, and financial management. Investment, a placement of capital in expectation of deriving income or profit from its use. Asset, something or someone of any value, any portion of one's property or effects so considered. Debtor, a person or firm that owes money, one in debt, or one who owes a debt. What are the two main drivers of finance? The two main drivers of finance are the time value of money and risk. Why is time important in finance? Time is important in finance due to the time value of money and the need to manage assets over time for maximum value. Shareholder, one who owns shares of stock. What is corporate finance? Corporate finance is the area of finance dealing with monetary decisions that business enterprises make. What is the primary goal of corporate finance? The primary goal of corporate finance is to maximize shareholder value.